Yeah, the S&P logging its worst week since early 2023. Well, CPI is the next big test for the market. Is recent data showing enough moderation in prices and economic growth to signal a soft landing? And ultimately, what does all this mean for the Fed's decision? Let's bring in Matt Maley. He is the managing director and equity strategist at Tabak. Matt, it's great to have you here. So talk to me about what's already been priced in and maybe what the market is anticipating. It certainly looks like investors are betting on the fact that we're going to see a 25 basis point cut next week. What does that then signal for equities?
Well, I mean, that is, I guess, somewhat helpful. I mean, the one concern is that, if they do feel that they have to go 50 basis point, I actually think that will scare some people because the market is not pricing in any kind of a hard landing. In fact, I would argue that they're not even pricing in, the market's not even pricing in a soft landing. It's pricing in a very strong economy going forward. So I'm a little bit worried that we're not going to get that over the next 6, 12, 18 months to kind of justify these moves in the stock market. But, the fact that the earnings are growing, the fact that the economy is still growing, should be able to help hold up things for a little bit of while. But at some point, when you get the market as expensive it is today, they have to kind of face the reality that 22 times earnings is really going to be tough to justify over a longer period of time.
And so, Matt, with that in mind, I mean, for the Fed, as they're trying to validate 25 basis points, if that was the decision that they made, if CPI came in, just as expected or even better than expected, how much does that continue to allow the Fed to just say, hey, we're going to go slow and steady with the amount of cuts that we're anticipating putting into the system?
Yeah, I definitely think that that's what they'll do. I mean, we get something that, unless it's really, really weak, and again, that might raise questions about what's going on with the economy. I mean, we see oil prices going down, we see China growth really slowing down. What kind of impact will that have? But I think they'd really like to go steady to get started, slow and steady to get started. And if they need to pick up and get more aggressive as we move through the rest of this year or into next year, they can always do that. But I just don't see the real need to make that move just yet.
Matt, what does that then tell us about what we will see leadership-wise? When you talk about the fact that tech, for a number of reasons, and you could blame some of it on NVIDIA, you can blame some of it for maybe starting to price in the fact that we could get rate cuts. Do you expect to see further pressure on tech, and how should investors then be positioned?
Well, one of the things we're going to see, of course, is what happens here with Apple. I mean, I guess the biggest narrative in the last 6-8 weeks has been that the earnings from the AI phenomenon are not going to broaden out to the degree people were hoping for this time last year or even 6 months ago. We're still seeing great numbers out of NVIDIA and some of these other companies, but the end users are not getting the return on their investment as quickly as people had thought. So if again, Apple doesn't necessarily have to fall flat on its face to be a problem, but they do need to show some signs that it's going to be something that's going to be positive, because most of the rest of these end users are really not seeing the return on investment we'd like to that would justify these big moves in the marketplace. I mean, Microsoft's spending $10 billion a month on this phenomenon, so we're going to need to see something out of Apple to really help things turn around a little bit.
And so in that case, is tech earnings growth more key to the broadening out than tech profit taking, and then some of that capital or some of that money going into other areas and other sectors for investment?
Well, the biggest concern I have about this issue, the rotation issue. Mm-hmm. I mean, the one thing is that we saw in the second half of August, or really the last 3 weeks of August, where the tech group, even though it was lagging, it only retraced about 2/3 of its decline, of its summer decline, while the S&P recovered all of its decline. So it was lagging a little bit, but that's okay. It was still rising. So people felt the confidence to be able to rotate some of their money out of tech and into other areas. But when the group started to roll over, it's too heavily invested, way too heavily, weighted in the S&P and the Russell the NASDAQ, the NDX 100. So as those indexes started to roll over, that made people much more nervous. And so I guess my point is that you need to have the tech group either rising, even if it's lagging, but if it's or for you to see any kind of rotation. If it goes down and the major indices go down, people tend to pull their money out and rotate into cash. So we got to be. So this tech group is going to still be very, very important over the next couple of weeks, and really for the rest of the year.
Matt, I'm curious to get your thoughts on the action that we've seen recently in the bond market, and whether or not maybe the initial reaction to the jobs report that we got Friday is that something that's now being recalculated, and what do you think about what is already being priced in terms of rate cuts, and maybe whether or not there needs to be or will likely be a further reevaluation?
Well, we could see. I mean, the bond market is being, the bond yields are getting oversold, which means bond prices are getting overbought. But that's on a short-term basis. So we could see a little bit of a bounce back in price and I'm sorry, a pullback in price and a move up in yields. But we, first of all, on a technical level, we've definitely seen this. We broke below that 3.8% key support level on the 10-year note. We've seen the 2-year note break down in a significant way, well below any kind of trend line, and it's made a lower high and a lower low. That's that's on the yield side. That's going down, but that means prices are going up. And I think that key change in trend for the bond market means that bond investors are going to do very well over the rest of this year. Again, on a near-term basis, I wouldn't be chasing the bond market. We could see a little bit of a pullback here, again, with a bounce in rates, but I don't think that will last very long because it just seems like to me like the situation, whether it be the geopolitical situation, which is still very rough, and the flight to safety move can play an impact in there. But there's no question that our economy, even if we're not going to hit a recession, it is slowing down. That bodes well for the bond market.
Matt Maley, who is the Miller Tabak Managing Director and Equity Strategist. Matt, always a pleasure to grab some time with you. Thanks so much.
Thank you.
Certainly.